Hi, welcome back to this course on infrastructure finance. This is lecture 11 and we will continue our discussion on analysis of project viability. For the past two lectures we have been discussing this topic on how do we actually analyze the project viability, and we have looked at two topics. The first was the time value of money, where we said that all cash flows that occur in the future has to be discounted to the present, and only then we could actually add up the cash flows that occur in different time periods. So we discussed this concept of the time value of money. The second was you will have to discuss the future cash flows to the present, and when you actually have to discount it, you will have to use a discount rate. And what is the discount rate? Essentially we said that the discount rate is nothing but the cost of capital, and we also discussed how do we actually determine the cost of capital for broadly different sources of finance, which would be equity, debt, and normally we also understand that companies have funding from a mixture of both the debt and equity. So therefore we will have to determine what is called as your weighted average cost of capital, and we also saw how do we actually determine the weighted average cost of capital. So in today's lecture we will talk about what are the different techniques that we can normally use for doing a capital budgeting decision. So when we talk about capital budgeting, it is nothing but how do you actually make investment decisions in long term projects. And before we actually get on to this topic, we will discuss the thought questions that we put forward in the previous lecture. So question number one is, why is debt generally cheaper than equity? When we look at the cost of equity and the cost of debt, we find equity to be more expensive as compared to the cost of debt. So we should kind of really understand the fundamental reasons behind why we normally find the cost of debt to be cheaper. So let us look at from the first principles. So if you look at the company's profit and loss account, the sequence that we have will be something like this. The top line would be your revenues, and then net of all expenses would give what is called as your operating profit. And from the operating profit we pay what is called as your interest. So if the company has any debt, then the company needs to service the debt by way of interest payments, and we pay the interest from the operating profit. The net we have what is called as your profit before tax, and then we account for tax payments, and then finally we get what is called as your profit after tax. Now the payments or the returns to the equity holders are essentially the profit after tax that the company makes, and the returns to the debt holders are nothing but the interest that the company pays. So if you look at the sequence, we find interest being paid before the profit after tax. So that means there is a seniority to which the debt holders get their payments, and the profit after tax is actually the net amount that the company makes after taking care of all the expense. So in essence it is considered to be a residual payment. Since the equity holders are eligible only to receive a residual payment after all the other claimants have been satisfied, they are considered to be what is known as your junior claimants on the firms. So given the fact that debt holders receive the payments much before the equity holders get, there is a certain amount of priority that the debt holders get in terms of receiving the payments, and this in essence gives you certain amount of comfort factor for the debt holders. So given this seniority that they have in terms of enjoying the claims from the firm, they actually are able to provide funds to the firm at a lower rate of interest. So the reason why debt is cheaper than equity is because of the fact that the seniority they enjoy, they are able to give source of funds at a lower rate of interest. There are other reasons as well. when the firm is not able to generate adequate cash flows to pay the interest, then it is considered to be a state of bankruptcy. So whenever there is a bankruptcy, whenever the company is not in a position to pay back the interest, then the lenders can actually take possession of the assets, liquidate it and recover their monies. So in those cases, again there is a priority to the lenders in terms of recovering their capital. So therefore in both the cases what you actually find is the seniority that the lenders enjoy in terms of receiving their payments helps them to actually invest in the firm at a lower cost of capital as compared to the equity, and the equity holders being the residual claimants on the firm's cash flows, they are subjected to the highest form of risk, and as we have seen earlier, risk is directly correlated to returns. Since equity holders are exposed to the maximum risk among all the investors in the firm, they are actually expected to get the highest amount of return, and that is the reason why we normally find debt to be cheaper than equity. Now what is the implication of this? The implication of this is that most projects would naturally get as much debt funding as possible because the cost of capital becomes lower, and if the cost of capital becomes lower, then the discount rate also becomes lower. Okay, so it is very important to actually get a project funded with as much debt as possible. On the other hand, if we fund the project beyond the capacity for which it can hold debt, then it also increases the bankruptcy risk of the firm. So this also needs to be remembered. So while it is advantageous for the company to get as much funding by debt because it is cheaper, we should also ensure that the company is not over leveraged, because excess leverage can push the firm towards bankruptcy, and as project sponsors we want to be not employing a strategy which will increase the threat of the firm's bankruptcy. The second question that we put forward is, how do we actually get the values of equity and debt for calculating the weighted average cost of capital? So if you look at the weighted average cost of capital, the expression goes something like this: after tax cost of debt multiplied by the proportion of capital invested by debt plus your cost of equity multiplied by the proportion of capital invested form of equity. So essentially the question is, how do we actually get the values of D and E? So if it is a new project, obviously we have the value of equity that we are going to raise, we have the value of debt that we are going to raise, and we are naturally going to substitute those values. But if it is an existing company, and if the company is planning to invest in a new project, and then it will have to calculate its weighted average cost of capital, and in that scenario the equity value is normally assumed to be the market value. So we will have to take the equity value not from the balance sheet, but we will have to consider the equity value from the market values. Now we all know how do we actually calculate the market value of equity. It is nothing but the market price of share multiplied by the number of outstanding shares would give you the market value of equity. So if you are actually planning to find out what is the cost of capital for a company that is listed in the stock exchange, then it is very important for us to find out and use the market values of debt and equity in determining your weighted average cost of capital. If we actually use the value of equity and debt from the firm's financial statements we may not get the appropriate value for weighted average cost of capital. So it is very important for us to understand that in the weighted average cost of capital equation the values of debt and equity are not the book values but the market values. If the firm is not listed, if the firm is in its inception, then the book value will be equal to the market value. So in those circumstances we actually use the value of equity at the price at which we actually make the investment, but in all other circumstances when the book value is different from the market value we will have to use the market values of equity and debt. Okay, now let us get on to the topic today, which is to really look at what are the different types of capital budgeting techniques that we have and what are the features of these different techniques. I am not going to talk about all the major capital budgeting techniques, but I am going to talk about a few that we most commonly see in being employed in infrastructure finance. Okay, the first technique is what is called as your payback period. So remember, when we are actually making an investment, as an investor we need to actually make a decision whether the investment is worthwhile or not. So there are various criteria that we will have to use, and using that to determine whether the investment is worthwhile. So that means whether the investment is profitable, are we going to actually get our returns back, and so on. So the payback period talks about the time that it takes for the investors to recover their initial cost outlay of the project. Remember, when you are actually making an initial investment there is certain amount of capital that is needed. So how long would it take for the investors to recover their capital? So that is called as your payback period. How long does it take for the project to pay back its initial investment is the fundamental principle behind this capital budgeting technique. So if you are planning to use this technique, what is the decision criteria that we have to deploy when we have to decide? So the decision criteria would be, we accept a project if the project payback period is less than the desired payback period. Now the desired payback period could be very subjective, it could depend on investor to investor, and so an investor A might have a payback period and an investor B might have a different payback period. But whatever it may be, if the project payback period that we calculate from identifying the firm's from project cash flows, if the project payback period is lesser than the desired payback period, then we go ahead and accept the project. So this is a simple rule by which the payback method operates. So let us take a simple illustration to find out how do we calculate the project payback period. So we have a project and the project cash flows as I have indicated in the table. So normally what happens is when we actually identify the cash flows, we identify the period in which the cash flows occur. So we always denote year 0 to be the present, and in this case year 0 there is a cash flow of negative 10,000. So that means there is an investment being made in year 0. Okay. So that is what essentially we mean by a negative cash flow. And then subsequently in each of the years there are some positive cash flows from the project. So in year 1 there is 6,000, in year 2 there is 4,000, in year 3 there is 3,000, in year 4 there is 2,000, and in year 5 there is 1,000. So what does it indicate? This indicates that this project has a life of 5 years and these are the cash flows that occur in each of the 5 years. So it is also important for us to understand about when the cash flows actually occur. So in reality the cash flows do not occur at one single point in a year, but it occurs uniformly throughout the year. But when we are actually doing calculations, for the sake of simplicity we assume that cash flows occur at the end of the year. So when we say that the cash flows in year 1 is 6,000, we assume that the cash flows of 6,000 in year 1 occur at the end of year 1. So that means today we are making an investment of 10,000. At the end of 1 year there is a cash inflow of 6,000. At the end of 2 years there is a cash inflow of 4,000. So it is very important to understand, and it's generally it's a common thing to denote that each of these cash flows occur at the end of the year. Now if you have a project with cash flows like this, what is the payback period? That is, we have to consider how long does it take for us to actually recover our initial investment of 10,000. So at the end of 1 year the project would have given a cash flow of 6,000. We initially made an investment of 10,000. So therefore at the end of year 1 the project is able to give back 6,000 and the investor has been able to recover 6,000 of the 10,000 investment that he has made. At the end of year 2 the project gives a cash flow of 4,000, and therefore by year 2 the investor is able to recover the entire capital of 10,000 that he has invested. So in this case the project payback period is 2 years, because by the end of the second year the investor has been able to recover the entire investment of 10,000 in the project. Now what are the features of this payback method? Let us look at some of the advantages and shortcomings. So the first advantage is that it is very easy to visualize. There are no complex calculations here, and we just simply say how long does it take for the investor to recover his initial capital, and since there is not much complexity involved in the calculations, it is quickly understood, and more importantly it is also easy to calculate. We just need to know what is the initial investment, we just need to know what are the cash flows that occur at different time periods, and with this two information we will be able to calculate your payback period. Second is payback period gives importance to project cash flows that occur early in the project life. Now it is another important concept that we have to understand in financing of projects is that cash flows that occur in the early years are compared to be more safer, less riskier as compared to cash flows that occur in the later years of the project life. So therefore an investor, if he is looking at two projects, would actually prefer a project that has cash flows in the early part as compared to a project that actually has cash flows in the later part of its life cycle. Now when we actually use the payback method, the payback method stresses on cash flows that occur in the early years. So therefore it helps us to eliminate projects that do not provide returns in early years. Now let us actually go back to the illustration that we discussed previously. So we have a project something like this, cash flow of 6,000 in year 1, 4,000 in year 2, 3,000 in year 3 and so on. But what happens if the entire cash flows, the cash inflows particularly is reversed? For example, the year 1 cash flow of 6,000 does not occur in year 1, but it actually occurs in year 5, but the year 5 cash flow of 1,000 does not occur in year 5 but occurs in year 1. So we flip the entire cash flows. So what happens to the payback period when we flip the cash flows? So when we actually flip the cash flows, the payback does not occur till the 4th year. In fact, if you look at it, for the first 4 years the project gives a total cash flow of 10,000. So it takes 4 years for the investor to recover the entire investment of 10,000, but in the example that we have just now, the investor is able to recover his investment in 2 years. So naturally a same project, a payback period method favors projects that actually results in early cash flows. Why? A project with early cash flows will have lesser payback period an investor will actually prefer a project with a lesser payback period as compared to a payback period which is longer. Let us also look at some of the limitations of the payback method. The first major shortcoming is that it does not use the time value of money concept. Remember, we discussed it. The time value of money is a very important concept, and cash flows that occur at different time periods cannot consider to be equal, and if they have to be added up, then they will have to be discounted to the present before they can add it up. So payback method, the traditional simple payback period method, does not consider the time value of money concept, and this is the biggest shortcoming or the biggest failing of this method. Second is there could be a certain arbitrariness in selecting the payback period. So the decision is we accept a project when the payback period is lesser than the desired payback period. When the project payback period is lesser than the desired payback period, then we accept the project. But how do we actually determine what is a desired payback period? So the desired payback period can differ from investor to investor, and there is no clear cut rationale by which we can actually determine what should be a desired payback period. Since there are difficulties in determining a desired payback period, it could also result certain amount of arbitrariness in selecting projects with a specific payback period. So if we actually have a rule saying that we will actually select projects that have a payback period of 3 years, why should we actually choose a 3-year period? Why not 4 years, or why not 2 years? So this criterion in terms of what decision criteria that we will use to select projects can be a little arbitrary, and this is one of the shortcomings of the payback method. The third, and again very important shortcoming, is the payback method does not consider cash flows that occur after the payback period. Remember, a project has the payback period. In this case, the project actually had a payback period of 2 years in the first example that we saw, but it does not consider any cash flows that occur after the payback period. Let me give you an example to illustrate this point. So project A was the first project that we discussed. So let us say there is a project B which again involves an investment of 10,000, and it actually gives cash flows of 5,000 each in year 1 and year 2. So as you can see, both the projects have a payback period of 2 years. So in those circumstances, which of this project will you actually choose? Because it is going to be very difficult to differentiate these two projects based on the payback method, because both of them give an equal payback period. But somebody who is actually looking at the cash flows will be able to find out that project A is a lot more valuable, because project A has cash flows beyond the payback period, whereas project B does not have any cash flows beyond the payback period. So therefore, sometimes a payback method will be very difficult to actually deploy because of the fact that we have no information. For example, if you really look at a company's top manager who actually is looking at the payback periods of different projects, it becomes very difficult for senior managers to go to the details of each and every project, and simply going by the payback method to look at which project should be implemented might not be a right decision, because in many cases there are valuable project cash flows that occur after the payback period, and as investors one should always consider all the cash flows from the project. Remember, we talked about sum of all the benefits net of all the costs. So payback method does not give us an indicator of a sum of all the project cash flows, and this is an important shortcoming. So we will actually go to the next capital budgeting technique, which is your net present value. So what is this net present value? So net present value is nothing but the sum of the present value of project cash flows minus your investment outlay. So we initially started with sum of all the benefits net of all the costs. So sum of all the benefits is essentially what is called as your sum of all the cash flows from the project. Okay. So we have cash flows that occurring from different time periods t. So let us assume that there is a cash flow occurring at different time periods t, and we actually use a discount rate to discount it to the present, right, 1 plus discount rate, and we actually have to use the discount rate depending on what time period the cash flow occurs. So therefore we actually discount it to the power of t. T indicates the time period at which the cash flows occur. So summation of all this, where t can range from 1 to n. So this actually gives you the present value of all the project cash flows, present value of all the project cash flows. And then we have what is called as your project cost. Project cost is nothing but your initial investment. Okay. So this is called as your investment outlay, this is called as your investment outlay, IO. We generally assume that the investment outlay occurs at year 0. Now in many cases the investment can occur over a period of time, but since we are starting the discussion, let us assume that the entire investment occurs at time 0. So the present value of the project cash flows net of the initial outlay. So that means if we subtract the initial outlay from the present value of all the project cash flows, the value that we get is your net present value. This is your net present value. Why it is called net? Because it is net of the initial investment that we made, and the present value is the sum of all the project cash flows. So this is the expression of what is your net present value. So as you will probably see in the later part of the course, net present value is a very, very powerful tool to make a capital budgeting decision. It is considered to be more robust, it is considered to be sticking to some of the fundamental principles that we have learned, such as the time value of money. So what is the decision criteria that we use? The decision criteria to decide on projects on the basis of net present value is, if the net present value is more than 0, we accept the project. So when can the net present value be more than 0? The net present value will be more than 0 when the present value of the cash flows is greater than your initial outlay. So that means the benefits are more than the cost, then the net present value will be positive. So when net present value is greater than 0, we accept the project, and we reject the project if it is otherwise, that is, if the net present value is less than 0, we reject the project. So this is a basic rule when we actually use the net present value criterion in making a capital budgeting decision. Let us do a simple illustration of net present value calculation. So we have a project with the following cash flows, right. The initial outlay is 10,000 because this is an investment, this is an outflow that occurs in year 0, so we can consider this to be an initial outlay, and then we have cash flows that occur from years 1, 2, 3, 4 and 5. Now for a project with the following cash flows, what is your net present value? So let me put it on the blackboard. So in year 0 there is an initial investment of 10,000, and year 1 there is an investment of 2000, year 2 there is a project cash flow of 4000, year 3 is a project cash flow of 3000, year flow there is a cash flow of 3000, and year 5 there is a cash flow of 10,000. How do we actually find out the net present value? So let us discount each of the project cash flows from years 1 to 5 to the present. Okay. So how do we actually discount it to the present? This is nothing but 2000 divided by your discount rate divided by your 1 plus discount. So if you assume the discount rate to be 10% for illustrative purposes, right? If you assume 10% to be the discount rate, then the present value of a cash flow of 2000 in year 1 is nothing but 2000 multiplied by 0.909. So similarly, you discount the cash flows of 4000 in year 2 to the present, you will get 4000 multiplied by 0.826. That is, we discount 4000 by 1 plus 10% raised to the power of 2 because it occurring in year 2. So next we have 3000. So this will be 3000 multiplied by 0.751, which is nothing but 3000 1 plus 10% raised to the power of 3 because it is occurring in. Now when we calculate all of this and add it up, the value that we get will be your net present value. Remember, the initial investment of 10,000 occurs at year 0. So that means the present value of the initial investment is 10,000. There is no need to discount because this is the investment that is happening today, this is the investment that is happening in year 0. So therefore there is no discounting that is applicable for the investment that is happening in year 0. We discount all the future cash flows, and when we add up the initial amount with the future cash flows, the net present value that we will get, remember we also have to discount all of this like we did for the first 3 years, and then if we discount all of this and add it up, you will actually get a net present value of 5634. So for a project with cash flows as given in the table, the net present value is nothing but 5634. Now let us look at another technique that is similar to the net present value but calculates the project viability on the basis of a ratio. So this is called as your profitability index. So profitability index is nothing but sum of the present value of project cash flows divided by your initial outlay. So in terms of the mathematical expression, the profitability index is written something like this. Profitability index is nothing but a sum of the present value of the project cash flows. So this will be the project cash flows occurring at different time periods t, and we divide it by the discount rate to get the present value, and the time period ranges from 1 to n, and we divide it by the initial outlay. So the ratio that we get by dividing the sum of all project cash flows discounted to the present by initial outlay is called as your profitability index. Now how do we actually decide how to use the profitability index? If the profitability index value is more than 1, then we accept the project, If it is more than 1, then the indication is that the value of the numerator is more than the denominator, so that means the present value of cash flows is more than the investment outlay, so therefore we accept the project. And if the profitability index is less than 1, we reject the project. So if you look at the same example that we did for the net present value calculation, then the value of the numerator, which will be the present value of all the project cash flows, will be nothing but 15634. So the profitability index for the project will be sum of the present value of all the cash flows, which is 15634, and divided by your initial outlay, which will be 10,000. So the profitability index value will be 1.56. So the value of the profitability index is more than 1, so therefore we accept the project. And if you use the net present value criterion also, the net present value criteria is positive, so therefore we accept the project. So generally you find that either you use profitability index or the net present value, the decision will more or less be the same in terms of accepting a project or rejecting a project. Let us look at another important capital budgeting tool, which is called as your internal rate of return. Now what is this internal rate of return? So internal rate of return is nothing but it is a rate of return that the project earns on the investment is made. So remember, whenever we are using the profitability index or we are actually using the net present value, we are actually discounting the project cash flows by the cost of capital, generally the weighted average cost of capital. But when you are trying to use IRR, we are actually employing a slightly different technique. That is, we are trying to find out how much return does a project give. We are not using a discount rate to discount the project cash flows. In essence, we are trying to do is what return does a project give over its lifetime. So the internal rate of return is nothing but the discount rate that equates the present value of the project's future cash flows with the project's initial outlay. So let us try and see how the expression is for the internal rate of return. So you have the initial outlay for the project. So the definition of internal rate of return states that it is a discounted rate that equates the present value of the project's future cash flows with the project's initial outlay. So this is a project initial outlay. So this is equal to the present value of the project cash flows occurring at different time periods t, discounted at a discount rate. So this discount rate we denoted it by the internal rate of return IRR. We discount it to account for the cash flows occurring at different time periods t, where t will range from 1 to n. Now when we try and solve this equation, the value that we get, which makes both the initial outlay equal to the present value of the project cash flows at different time periods, is known as your internal rate of return. So what is the decision criteria? We accept a project when the internal rate of return is greater than the required rate of return. Remember, we all know that every investor has an expected or required rate of return. If the project provides a return that is higher than that, then we accept the project. In a sense, the required rate of return is also nothing but the cost of capital. If the project gives a return that is higher than the cost of capital, then we go ahead and accept the project. And if the IRR values is lesser than the required rate of return, then we reject the project. So this is a decision making criteria if we actually use the internal rate of return. So let us do a simple illustration for the internal rate of return. We have a project with cash flows over 4 years and an initial investment of 100. So what is the required rate of return, what is the internal rate of return, sorry, what is the internal rate of return for this project? So if we have to formulate this equation, then we have the initial investment of 100, this 100 will be equal to the present value of the cash flows that occur at different time periods. So for the cash flow that occurring in year 1, 20 discounted to the present at the internal rate of return, then the cash flows that occurring in year 2, 30 1 plus IRR raised to the power of 2 because the cash flows are occurring in year 2, and then cash flow of 40 in year 3 divided by 1 plus IRR raised to the power of 3, and then cash flow of 45 in year 4 1 plus. Now we will have to find out the value of IRR which satisfies this equation. So that is the project's internal rate of return. The value of IRR at which this equation is met is called as your internal rate of return. So let us find out the project's NPV. If we do a discounting at 15%, then the net present value is 0.8. On the other hand, if you discount the cash flows at a rate of 16%, the net present value is minus 1.36. So therefore we can understand that the discount rate at which the equation will be satisfied, will lie somewhere between 15% and 16%, because the direction of the net present value changes as we move from a discount rate of 15% to 16%. So if you want to illustrate graphically, so we have a graph where the NPV is your y axis, and then on the x axis we have discount rate. So the net present value will be the highest when the discount rate is 0. As the discount rate keeps increasing, the net present value keeps on reducing. So as the net present value, as the discount rate increases, the net present value keeps on reducing. So at some point in time, at very high discount rates, the net present value becomes negative. So this region is a region where net present value is less than 0, and this is a region where net present value is greater than 0. The point at which the line crosses the x axis, right? So this is the point where the net present value is equal to 0, and this discount rate where the net present value is equal to 0 is your internal rate of return, So the internal rate of return would lie between the area where the net present value is positive and area where the net present value is negative. So the net present value of the project at 15% discount rate was 0.8, and the net present value at 16% discount rate was minus 1.36. But if you calculate the IRR lies between 15% and 16%, and it is actually 15.37%. Remember, manually calculating this IRR equation might be little difficult, because in this case the project life is of 4 years, and this results in a polynomial of the 4th degree, and calculating this is going to be very difficult. And if you actually have project that actually has even longer life, then we are actually going to get an equation which is even more complicated, a polynomial of even higher order. So to calculate IRR, we simply use a technique that is available in scientific calculators or in Microsoft Excel, where we have an IRR function built in, and we can use this function to estimate the internal rate of return in reasonably accurate fashion. Okay, before we end today's lecture, thought questions for you to ponder on. One is, what are the shortcomings of using internal rate of return when we have to decide on which projects to implement, which projects to select. Second is, what are the assumptions behind the IRR calculation that we should be aware of. Remember, we should not blindly go about and using a method without being aware of some of the assumptions that go on behind some of these techniques. And an IRR is considered to be a very attractive technique, and it intuitively appeals to people because it gives a return in terms of a percentage. Though it is very appealing, though it is intuitively makes a lot of sense, it is important for us to understand the assumptions that lie behind this IRR calculation before we go ahead and start using it in an extensive way. So let us discuss these questions in the next class, but I would also encourage you to think about some of these aspects, and we will see you in the next lecture.